Welcome to the Daily Session Briefing for Wednesday, July 15th. Before we dissect the tape, we start with our foundational rule, absolute accountability. Yesterday, our technical models forecasted a down close for the S&P 500 and Nasdaq. Instead, the index is squeezed late, with SPY closing up 0.38%. That makes yesterday's call incorrect. Let's look at the underlying mechanics to see what drove this squeeze. Looking at slide 2, we see a massive divergence between the surface indexes and the subsurface market internals. On the surface, things look perfectly healthy. The Dow rose 0.02%, the Nasdaq surged 0.90%, and the S&P 500 climbed 0.38%. But look underneath. New lows actually outpaced new highs at 52.9% versus 47.1%. This means the broad market is actively fracturing while megacaps hold up the headline indices. Our internal participation meters on slide 3 confirm this structural indecision. Advancing stocks flatlined at 48.7% versus 46.8% declining. More importantly, both the short-term 50-day moving average and long-term 200-day moving average metrics are pinned directly at the 51% neutral line. This proves the market currently lacks any true, organic directional conviction. So, who is holding up the floor? Slide 4 exposes the extreme sector polarity. Massive institutional capital is hiding in high-beta semiconductors like Nvidia, up over 4%, and Micron, surging nearly 5%. Financials like Goldman Sachs also provided major support, up 9%. However, this is masking massive capital destruction elsewhere, highlighted by a catastrophic 25.2% collapse in IBM. Our sector polarity table on slide 5 highlights this concentration extreme. The entire market floor is resting on a fragile equilibrium. High-beta semis are being used as defensive proxy shelters, while traditional defensives, like healthcare and drugs, with Eli Lilly down over 2%, are being aggressively sold off. This is a highly top-heavy, vulnerable structure. Turning to the technical reality on our 1-hour chart, we can visually see this coiled spring. Despite the internal weakness, institutional buyers have aggressively defended technical support in the 29,200 zone. Right now, the Nasdaq is trapped in a tight, low-volatility consolidation at 29,586. The technicals are coiled, waiting for a major macro tiebreaker. Slide 7 maps out our binary setup. On one side, we have fractured breadth and mathematically negative broad participation. On the other, we have hyperconcentration in semis and Goldman Sachs. Because the index lacks the internal strength to absorb a shock, the upcoming session is highly fragile and completely binary. That brings us to tonight's risk radar. The macro tiebreaker arrives during a high-probability volatility window starting at 8:30 p.m. Singapore time with the core PPI release. This is followed closely by Federal Reserve Chairman Warsh testifying at 10 p.m. These events will force the market to break out of its current technical consolidation. To wrap up tonight's tactical outlook, despite the Nasdaq's defense of the 29,586 level, the negative market breadth and extreme concentration mean the index is fundamentally unstable. Therefore, our definitive directional call for tomorrow's close is down. Remember, we are predicting the final closing print, ignoring intraday swings. A close within 0.2% will be graded flat. Manage your risk, and I'll see you at tomorrow's closing bell.